Hey everybody, welcome to Raising Millionaires. I am your co-host Roger Bryan, and this is
Richard Lorenzen.
Today we are going to unpack the current market conditions and we're going to focus in on the market crash. What is going on with the tariffs? What is going on with your portfolio? How is Warren Buffett got a crystal ball that he doesn't share with anybody else? And then what the heck are we going to do? Right? Richard and I have been sitting here talking for like 10 minutes when we should have pushed the record button. I've got some screens up. I've got some options up. We're watching the markets today that were up. The Dow was up as much as 1,400 points. And we're going to close down, Richard. We're going to close down after a 1,400. And this happened yesterday too, right? I remember walking into Carter's, what do they call it? Well child visit, like the annual checkup. Mm-hmm. And coming off the back of supposedly fake news, the markets jumped by 12 or 1,400 points. Mm-hmm. I mean, we still ended up a little bit, but today seemed like it was going to be a nice little bounce. Mm-hmm. I think I texted you last night. As long as the U.S. closes down 1% every time China closes down 7%, we'll win this trade war. That ain't happening today. What's going on?
Yeah, so today's Tuesday, April 8th, right? And so we opened up this morning thinking we would see a bounce from what we had last week, which was basically Thursday and Friday. We're back to back 4 to 5% legs down, right, for the market. Yesterday, Monday, we had a really volatile day. We opened up down again. Looked like it was going to be another 1,500 point down day on the Dow. And ultimately, I don't remember where we closed, but we kind of whipsawed around to we closed that gap and then we took another leg down and then closed it again. And I think ultimately the Dow closed down maybe 300 points yesterday. And then this morning we had, at the open, we were up 1,400 points. We've seen that kind of taper away gradually throughout the day. It's 2:00 now. And I think we're just about at even for the day. I'm not looking at the indices, but I think we're just about at even. So there's a lot of volatility. But there also looks like there was a little bit of buying that started taking place this week after just oversold conditions Thursday and Friday last week. So what was your reaction, Roger, to the selling Thursday and Friday?
So it was interesting. I think one of the things that I like to listen to on CNBC is where they talk about the retail retail traders, not investors, the traders, and how they had bought into the decline in a lot of like the top 10 traded stocks for retail investors. The Teslas, it's funny, Ford popped into the top 10. Everybody trying to dissect what's going to go on with tariffs and how it's going to affect Nvidia, all of these different things. But then that faded yesterday. The retail investors started to lose the retail traders started to lose their steam. And then you saw the market kind of come back up on some fake news. I'm going to tie that together. Right now, what I've got up on my screen is I got the SPY April 11th call, 504, which is right at par. The bid is right around 1260. So it's looking for about a 2.5% bump in the S&P by Friday in order to cover this call. Why do I think that's attractive? Phase one of the tariffs have gone in, right?
10%, the initial, the flat 10% tariff on everything.
Flat 10%, which if you go back a couple weeks, I said it actually makes sense if we're going to do tariffs to put a flat tariff across the board, right? It's a measurable income stream. I got to be careful with this. Some other countries have it. I think most, but I don't have statistical data up in front of me. It creates a revenue stream. It's also predictable, transparent, right? The whole market can adjust to it. You can do your economic modeling around it. So do you know what the S&P's bouncing by a buck? When you're doing options, every little bit helps. So I'm going to watch this until 4. But tomorrow, the big tariffs go in. The retaliatory tariffs, whatever the hell you want to call them, whatever magic formula the administration is saying they're using that no one had ever heard of before.
I think they're reciprocal.
They're reciprocal my ass. There is a probability, based on Trump's history, that he could potentially, possibly postpone them. And if that was the case, you would see something like you saw yesterday, which was a 1,200 or 12 or 1,400 point bump in the Dow, just based on the potential that Trump might do something about it, right? So if I am to take this position, I will probably, if I take it and I have a 2.5 points or 2.5% spread, I would probably put it at a 5% uptick, like I'm to close out, and I could double my money on it, right? And that would be the bump. If he says anything, I would get that bump. Now, when I think about the downside of that trade, if he says nothing and it goes through, is the market going to tank more, or is it going to stay kind of steady? We've kind of gone, we got a little bit of a boost yesterday. We're kind of going sideways today. Is the upside potential for that move greater than the downside risk? Because it's an option, right? At 1 day closer to expiration, I'll probably lose 30% of whatever I put in just to stay even. Yep. So I've really got to judge this on how I'm going to play and hope, right? We were talking, if Trump's going to do something, he'd probably say it tonight, right? After markets close, or first thing tomorrow before markets open.
Yep.
Now, the safe bet would be like, Richard, you know me, if I buy an option, I want to know that the statistical probability of doubling my money in that option is as good or better than what would be 10 times better than if I just bought the stock, right? Because if I bought the SPY and it went up 5 or 10% this week, that's great. But if I buy this option and it goes up 5%, I double my money. If it goes up 10%, I quadruple my money. And I see that as a potential, it has a high probability based on Trump's history. You know what's funny? I've been careful about saying his name. I had a YouTube video get flagged for being not political, but campaign oriented. And believe me, the industry that video's in is so far from, and you know what industry it is, so far from anything related to that. I was like, what the hell did I do? I must have said the T word somewhere in there.
Interesting.
I guess in this video it doesn't matter. We don't run ads to this stuff. But that's like short term, right? Short term.
Right.
Retail traders losing steam. Often that does relatively mean that you're going to get like a plateau or a bottom, right? Because they're the last ones to wake up, the dumb money, which it's not as dumb as it used to be with all of the available data and things like that. But it does show me the potential for some type of bottom. Now, if you're a long-term investor, if this is in a retirement account, I would be, I think you bought into this, didn't you?
Yeah, I wish I had bought a little bit more before today's bounce. I'm looking for another opportunity to buy. So, like, if you're a longer term investor, assuming that your window is, honestly, even if your investing window is just 5 to 10 years out, not even very long term, there are opportunities out there right now, and I think there will be more opportunities just given the volatility and uncertainty we're seeing politically. I think you're going to have more opportunities to buy things at a pretty nice discount that will work out well in the long term. Not financial advice. Everybody should figure out what's best for their risk profile, their portfolio. But I, as a long-term investor, I am looking at the legs down we saw last week, the uncertainty we're still seeing this week, as being a buying opportunity for a long-term position. So that's where I'm at. I think it's interesting. There was a Warren Buffett video that I saw over the weekend, and this wasn't a recent video. I think this was Warren talking about the sell-off during the pandemic, but it kind of applies to all sell-offs. He was talking about how kind of paradoxical the human psychology is around a sell-off in the stock market, and the idea of you're supposed to buy stocks low and sell high, but psychology a lot of times causes us to do the opposite. We want to buy things when they're going up, and then when they go down, we panic sell. And he had noted how different that is from, like, if you take a real life scenario, like going to the grocery store, right? And let's say a dozen eggs cost $5, and you go back the next day and the eggs cost $4 and the price is down 20%, most people would say, hey, this is terrific. I want to buy more eggs, right? But when the stock market goes down 20%, it's the opposite. Everybody wants to sell. Everybody thinks that the stock market knows something that they don't. And so that, as a long-term investor, that's usually something to keep in mind. I would wager to say that most sell-offs that we've seen in the past 100 years, I would almost I can guarantee that any sell-off that we've had in the stock market in the past 100 years was a buying opportunity over, let's say, a 10-year window, or even a 5-year window, and certainly over a longer-term window than that. So
Yeah, I do think, and I know we've talked about this before. What's that tool that you really like for forecasting and experimenting?
projection lab for forecasting.
Yeah, I remember how much that tool pissed me off because no matter how I reallocated my assets, I could not make it through the Great Depression, right? Because it does the back testing, and I could beat any economic cycle that had ever existed in their back testing except the Great Depression. And I do think that there's a 5-year window that's part of that cycle that would not have been a good idea to buy into. But that's like one in a, I mean, that's even more than 100 years, right? No, not even
It's
100
30,
years.
but
Yeah. But going along with what you said, it's interesting too. The $500 call is only $1.50 more expensive, but it gives you an extra $2.50 cushion on where we need to go. So I've changed it a little bit more expensive at 15.15, 15.10. But okay. Speaking of Warren Buffett, and I joked about this at the intro, right? You look at all of the stock that he sold in Q4 of last year, leading up into the inauguration. And now you look at those same companies today that have been absolutely hammered by tariffs, right? Well, the whole market's been hammered, but like Apple, right? We were talking that Warren Buffett sold at 223 and it's at 177. It's like a $50 price per share.
yep.
How many did he sell? 100 million shares?
He sold a lot. I mean, Apple was either his largest or his second largest. He might own more Coca-Cola than Apple, but it was top two in terms of the holdings in his portfolio. He sold a significant portion of it. I think the majority, if not close to all of it. The timing for a guy who claims to not try to time the market, the timing worked out very well for him.
Well, and that's the thing, though. Like, I don't even know if it's timing the market, right? Trump did this in his last administration, right? In a smaller, like, he told us he was going to do this. So the people at Berkshire Hathaway, in fact, I wore this shirt today to commemorate the genius that is Warren Buffett, because, like, this wasn't, like, you don't need to be an oracle. You don't need to have a crystal ball. You just have to be paying attention.
Well, that's a good point. And I think at the time when Berkshire sold that stock in Apple, I don't know. We're speculating to say it was because of impending tariffs, because I think at the time the clarification that they gave was that they were just selling because they felt that tech was overvalued, the market was frothy, et cetera, et cetera. Although I'm sure that the election outcome might have played into some of that, but it's a good point that since day one on the campaign trail for the 2024 election, the Trump campaign did say that tariffs were going to be a significant part of the economic strategy that they had.
And China was going to be a primary target, and Apple
More
produced
or
the
less,
majority of their phones in China, right? The writing was on the effing wall.
they telegraphed pretty much exactly what the tariffs would be. Maybe they came in a little higher than people were thinking, but more or less they told us exactly what the tariffs would be, who the tariffs would be on, and when they were going to do it. And so it is surprising to see that more of that announcement that we saw last week, which tanked the market, wasn't already priced in to some of these valuations, given that somebody's been the campaign was saying for over a year that this is exactly what they were going to do. Was it denialism? It's hard to say, but it's interesting to not see more of that having already been priced in. And it's also interesting to me that for somebody who's a long-term investor, why you would allow that. Tariffs are bad, and it is going to cause disruption. But in the long term, would if you're sitting on a long-term portfolio, would you really let some of those news headlines drive your decision to sell some of those long-term positions? I think it's harder to justify some of those decisions, and I think some of it is panic selling. I think we are oversold on some
I
of these.
do want to make sure that I chime in on. I don't think that tariffs are bad, right? I think the way they're being implemented is horrible, but I don't think we as Americans pay enough attention to the fact of how high tariffs are in other countries when our goods go over
That's
there.
fair. That's fair.
Yeah,
I think there are some nuances there, right? I think
yeah, there are definitely
nuances
nuances.
in
Yeah.
the size of the tariffs, who the tariffs are on, and also just how the policy is being yeah, kind of the uncertainty in a lot of ways around when the tariffs are going to happen, how much they're going to be, the constant walking back of some of these policy announcements. That uncertainty, I think, has also been more detrimental to the market than the actual tariffs themselves.
Oh, and
Uh,
again, that's right. The play that I'm looking at right now, which by the way, that same $500 call that was 15.56 a minute ago is down to 14. So right, I just saved myself another $1.56, and I'm just watching this as we go through the end of the day. And again, this is pure speculation, and I don't
don't
have to
think
give a
so.
caveat to investment advice because I'm doing the trade myself in my own portfolio. So by the time you watch this, trade will already have played out, right? Bids down to 14.
Don't do this at home. Yeah, I mean, so
All the markets have turned negative while we were
yeah,
on this.
everything is negative. Nasdaq is now down half a percentage point. That's up after being up 4% this morning. So that's a reversal, very strong reversal. Some of that is being driven by about an hour or two. We had a news headline come out saying that Trump was going to up the tariffs on China to about 104% because they had not yet engaged in any kind of meaningful negotiation. So that's part of what faded the rally that we saw earlier this morning. And then you do also have all of these tariffs going into effect at midnight tonight, and so there's a lot of anticipation around that as well. Crude oil continues to go down. The crude oil is at $59, $60 now. So that's something interesting to watch as
Ooh,
well.
now we're seeing about like, okay, so that same option was at 14. Now it's at 16.58. And the market just jumped by 300 points.
Mm, interesting.
And so that's the whole timing of it, right? It's impossible to time this shit. It's impossible, right? What's the
10-year yield is coming down as well. Just interesting to watch that because the
it
10-year
was,
yield.
but then it jumped up 5%.
Well, we saw a rally in the market, but overall, the 10-year yield is coming down pretty steeply compared to where it was a few weeks ago. And with a Fed rate cut almost certain in June, which I think is the next meeting, if I'm not wrong, I would expect to see rates come down even further. So that's also going to drive some of this, I think, as companies start seeing a lower
Are
cost.
you a Steve Leisman or a Rick Santelli guy when it comes to that? Steve Leisman's like, the data says they can't cut. They can't cut.
Well, I think they're going to cut. I don't know if the data is changing too rapidly, I think, right now to really get a solid reading on it. But I think they're going to cut. Just if nothing else, I think that they do feel some sort of an obligation to reassure businesses that that they're ready to step in if there is a serious liquidity issue in the market, just given the declining asset values.
What if this is all a game, right? And it's all mapped out. Like, we're going to implement all these crazy tariffs. They just started a sovereign wealth fund. They drive the market down by 20, 30%. They put $1 trillion into the market, and then they take it all back and let the economy rip and see a 50% gain on it. And they're like, look, we just made $500 billion, and we drove down rates, and we drove down the price of gas. could you see an administration doing that? I'm not speculating about this administration, but is it possible?
Well, I think that's a scenario that could play out. Would you see an administration do that? I don't know. It's funny. There is actually a school of thought out there right now that I've heard other people talk about, um, among like CEOs and investors who do think that could be part of the strategy. Who
Because
knows?
the strategy is so bad that the only way to explain it that it's so bad on purpose. Okay, I'll say it. You don't have to.
Well, I think there are a lot of different ways that this could go. Like we were saying before we jumped on here, you have also people within the administration who are starting to become more critical of the tariff policy. You have people who are influential Republican donors, Ken Langone, Bill Ackman, who are also coming
Sorry, I
out.
hear that name and I throw up in my mouth
I
a
know,
little bit.
I know, but uh, you also have to think about the strategy behind why some of those folks are deciding to come out and say some of this in the press too, and so there are a lot of different things that are at play there. So going back to your trade, I think there is an interesting play there, and potentially there being a chance that the administration comes out and before I guess 12:01 tonight, because that's the deadline for when these tariffs go into effect. Before 12:01, saying that they are going to do a 90-day pause or some kind of a walk back.
For those of you that are watching, if you ever see Bill Ackman share his view on where things are going, you need to know that he's already made his money on that direction. And it's not even that he needs to dump anymore. It's already done. It's already over. Don't trade into it. He is already
He's the fast money. He's the fast money.
yeah, and he's forecasting what he wants the dumb money to do so he can make his next move. I would love for somebody that can write an algorithm to check all of his public statements in the last 15 years against market moves that relate to the topic and tell me if I'm wrong. I bet you with 90% certainty that I'm right. So, Richard, what does someone do? What do you do in all of this?
For me personally, what I'm doing, I'm staying long term. I think if you're a long term investor to a certain degree, you have to learn to tune out some of these day to day headlines and corrections, sell offs. Over a 10 to 30 year timeline, depending on your goals and your age. And again, this isn't financial advice. Like you have to make decisions based on your objectives, your risk profile. But over the long term, if you look at a chart, the market is higher. It's always been higher, and it will continue to be higher. And so as a long-term investor, you have to develop the discipline to tune some of this stuff out. Maybe you use some of these sell-offs and corrections as a buying opportunity. But
There's a question on that,
dumb things.
right? I had to look this up. I heard this earlier today or yesterday. There's $6.9 trillion of cash in money market accounts right now. That is the gunpowder to explode this market in a positive direction.
Money? Does it differentiate between retail money or?
Let's see here.
I wonder how that compares to 5 years ago or 2
No,
years.
it's a record. I mean, it's an absolute record.
So there's money. There's a lot of money sitting on the sidelines.
There is a lot of money sitting on the sidelines. I don't know.
That's true in a lot of asset classes too. Like you look at private equity. A lot of times, you're talking about private companies at that point, acquiring private companies. There's a lot of dry powder on the sidelines there. You've got retail and institutional investors who have money to put to work, and I would even
What's
go.
it going to take to get that money back into the market?
I would even go as far to say that it's not necessarily the tariffs that are driving some of those investors away. It's just the uncertainty around the implementation of those tariffs that's driving a lot of buyers away. one of the worst things you can do as a long-term investor, in my opinion, just my opinion, would be to, assuming this is money that, I'm not going to need for, let's say, at least 2 more years, I'm not going to sell stocks because of these temporary, fluctuations, flare-ups that we have in geopolitics, domestic policy, the economy. I don't see how that makes sense.
No, I somewhat agree. They were talking to private wealth management. You see that there was a pull away from the Magnificent Seven coming into the administration. Like there was a boom right as the administration took over. But then from an asset reallocation perspective, in being more diversified, you were trying to many of the private wealth managers were trying to come out of the Mag 7 because they've grown so much, so fast that you had to start asking, they're going to have to be brought back down to earth. And did that money go, is it in high yield? Is it in bonds? As bonds are coming down? Where is it part of that $7 trillion sitting on the sidelines?
It's a good question. I don't know. It's tough to diversify away from the Mag 7 when, what is it, like 30% of the S&P 500 is the Mag 7, roughly. And so what are you going to do? Are you going to buy the Russell? Interestingly, the Russell's been really hard hit. Maybe not as hard, but it's been really hard hit. Despite the fact that the Russell tends to be smaller cap companies, you would think maybe less exposure to international tariffs.
Well, you know what the thing is with that too. Now, I don't know if you've talked to. I know you know a lot of the big players in the e-commerce space, but these tariffs, right? They've got to be destroying a lot of the SMB e-commerce players. When I look at our e-commerce business, I'm already trying to book 3 containers out to try to lock in pricing. And I'm thinking to myself, okay, you've got a container coming in 6 weeks. I know where it's coming from, right? I'm buying the product for this price now. Is there going to be 100% tariff on top of that? Am I going to get my product at the price I paid? Or is it going to hit the port and you're going to tell me, hey, you need to pay me double because it's stuck at port, right? I am stuck on that right now about pulling the trigger on my summer supply because I don't know if my supplier is going to hit me with something. And they don't know to tell me because they don't know what they're going to get hit with. And so much of the small to mid-size e-commerce players, your product comes from China, right?
That's a good point. That's a good point. If you're an e-commerce company, if you're any company who has a supply chain that touches outside the United States, you're going to be impacted by those tariffs, whether or not you're a Fortune 500 company or you're a small business. But there are also a lot of smaller cap companies that aren't necessarily e-commerce. They don't really have an international supply chain that I would think. I wouldn't go as far to say that they're benefiting, but I would think that they're more insulated than other companies that have international exposure.
Yeah, there's 2 local companies, service-oriented, manufacturing and service-oriented here in the Midwest that I talk to and work with. And while they don't see tariffs as having a direct impact, when you start to question them about, well, what about the trucks, right? Mm-hmm. What about your vans?
Sure.
What about the pieces that you buy to manufacture the product that you sell? I don't know that they've necessarily thought through all the stages of supply and how it's going to affect them.
Yep.
I know I was at dinner with friends 2 months ago and someone was talking about getting a new car and I'm like, you better go get that now. And like 2 days later, they had a new BMW SUV and she texted me last week and she's like, Roger, how did you know this stuff was going to happen? Like, well, I watch the news, so it's not really like anything like a crystal ball. But I think some people still may have their head buried in the sand about what's coming down the pipeline for toys, shoes, back to school next summer, right? All of the stuff our kids use for school comes from China. Imagine if school supplies double in cost, 100% tariff, right?
Yep.
Nobody has stocked up product, Walmart, Target, none of them, to make it through to the beginning of next school year, right? Because it would make no sense. That defies just-in-time supply chain. So I don't know. I feel like I am bouncing around all over the place, but me as an individual, when I'm planning out my own finances, I'm thinking about how it affects some of the entities that I own. I'm thinking about how it affects the entities of people that I work with because that's how they pay me. I'm thinking about how it affects my investment portfolio, how it affects the kids. I am thinking about how the different stages of this will play out with the products that, like, if I want to go buy new shoes for the kids, right? Do I need to buy them now instead of 2 months from now? I can't really buy back to school stuff for them because they're young. They keep growing. It probably won't even fit. That call is now below $14, $13.90. The reason that I keep talking about this one call on this podcast is it's interesting to see the dynamics of the market at work as we're talking, because this type of volatility is not normal, right? It's a day trader's dream to have this type of volatility, because if you've got enough cash to play with, then you can be right 51% of the time, and with the right downside protection, maybe you lose 20% on your wrongs, but your right should hit 100, 200%.
Yeah.
I need to think about, I can't really protect the downside of this one because it's an expensive option at $1,400. I normally wouldn't buy something that's more like my options. I'm usually at like 50 cents, $1, maybe $5. Buying a $15, $14 option is really not something I normally do.
And so for the people listening who are less familiar with options, when you talk about what did you say, $14 option? Like, you walk through like what that. So an option contract is 100 shares of stock. So when you're talking about $14 for an option, you're talking about $14.
Yeah,
you walk
and
through.
you can rotate between the word of right and obligation to buy those 100 shares at that price.
Right.
My intent is never to do that. My goal is to buy the contract, the option to buy the stock, and then let the price increase and sell that option back on the market to someone else that may actually want the option to call the stock at that price. So the reason for this is it's a leverage play, right? I could buy the stock directly, but I am taking a timed risk at a specific price in lieu of, so it's a 100x leverage on that, kind of, sort of. It's the easiest way to explain it. It's just a leveraged way to play it.
I mean, it's a play that you're going to know within the next 24 hours whether or not it's working out or not.
Oh yeah, this would be a 931 exit, right? I say a 931 exit means I would expect that whatever I put as my sale price on this, because it would be pre-programmed, that it would execute at 931 tomorrow, right? Whether I'm down 20% or I'm up 100%, the exit's going to be automated. I don't need to be sitting in front of a computer to do it.
The $1 million question is just, how will the market react if the administration does nothing? And in other words, the tariffs do go into effect.
Yeah, that's my downside. I'm assuming that it stays like flat.
Yeah, exactly. So is that already, is the market going to drop significantly further if the tariffs do go into effect, or has it already priced that in from those two huge drops that we saw last Thursday and Friday? Which, in other words, did the market take the administration at its word when it sold off on Friday, or did it still not fully bake in these tariffs actually going into effect? And
the only way that I can look at that, though, is unless Trump comes out, like, we've got these ridiculous retaliatory tariffs on China, which China is the number one enemy in all of this. So I'm not actually against much of that, even with the direct negative impact that it has on directly related businesses to my personal wealth. But if he came out and did something crazy like this to Canada, Mexico, Europe, Like, I would highly expect him to come out tomorrow and say, we're now talking to 70 countries, and those 70 countries that have reached out, we are going to delay this 90 days to work out deals with them. It would make sense to do that. It would tell the other 100 or some odd countries that you effed up by not calling me and coming to the table, right? You're not in line to get this fixed. You're not on our side. You must be communist.
There is a negotiating strategy in that for sure.
Art of the deal. Didn't you give me... No, you know what? That's locked in my safe.
So,
did you give me that for my 40th birthday, or did you just randomly get it?
I don't know. What year was that?
You got Donald to sign a signed copy of the Art of the Deal?
Yep.
I think I read that book for the first time when I was like 14 or 13 and became obsessed with stocks.
Ironically.
At no time while I was reading that or even working for the Trump family 10 years ago did I ever, 2012, 13 years ago, 14 years ago, 2011, think that this would be our political world today. Isn't that crazy?
The world works in mysterious ways.
Yep.
So now the markets are... it's kind of holding steady, but they're down a fraction of a percentage point. The Dow is up a fraction of a percentage point, basically break even.
Okay, here's a good question, though, and I'm going to pull this up real quick. Do you think, given everything that we've talked about, so hold on, I'm going to write down, so SPY was at about 2.5% to par. I'm going to pull up QQQ now because would we assume that the NASDAQ would actually, oh no, I don't want stock ETF.
So the QQQ is the index fund, one of the index funds that trades, it traces basically the NASDAQ, just for reference.
So here is something, oh wait, I gotta be careful, that's 4.8, that would have been a 4.11. Okay, so 222 par, 220 margin, 1358. It's actually about the same. Maybe
the spread
slightly higher, 2.8%.
Okay.
So basically, what that means for anybody that's listening is that the NASDAQ would have to go up by 2.8% from where it's at today by close Friday for the option to be priced at the price that I would buy. So if I was to take a 2.8% to par margin over a 2.5% par, that would I would be assuming that the NASDAQ will bounce more because it has been more volatile based on it being tech heavy, which isn't actually a terrible play.
If you were looking to magnify the movement one way or the other, the NASDAQ is usually a better index to do that with. The NASDAQ tends to be more volatile. It tends to magnify the direction of the rest of the market, and there's a lot of fancy reasons for why it happens that way, but I guess one of those reasons would be that the NASDAQ being heavily tech concentrated, it amplifies the movement of the S&P, which is at this point about 30% of the S&P is Mag 7 anyway, but with an index that's fully tech concentrated, you're going to see a more magnified move of whatever the S&P is doing.
Now, would the QQQ then be more prone to the China effect because so much of tech plays on really Tesla, Apple, NVIDIA?
Yeah, I think so. But that's the idea here, right? Is that if we want to
but China is still the what is it, the black herring or whatever of this entire equation, right? We could see moves everywhere, but China's out. Right?
That's true. It does seem like China is the least likely of all the different countries right now to get a pause before these, especially considering that just a few hours ago, the administration came out and increased the proposed tariff on China. So they seem to be the least likely country to get any kind of reprieve. That could have a disproportionate impact on tech companies.
Got it. All right, so for those of you that stayed with us through a lot of this rambling today, these are the thoughts, right? You might not be looking at it from an options perspective, But thinking about short-term portfolio, 2-year horizons, long-term retirement horizons, its direct effect on your income, whether that be you as a small business owner or you from a consumer goods perspective, cars, clothes, kids' school supplies, your kids' retirement. We didn't really put into the equation real estate, but that's going to have a direct correlation to interest rates. So all of the things that you do in your financial life are related to the moves that we're talking about on this call. And you have to really think about it, how it is going to affect you today, tomorrow, 2 years, 5 years, and then whenever you're like my 2040, which is in 15 years. Richard, I don't know if you're a 2050er or whatever that might be.
My favorite holding period, in the words of Warren Buffett, my favorite holding period is forever.
I've never been good at that.
Interesting. Also, one last piece of breaking news about 20 minutes ago, the U.S. trade rep came out and said that not all of the tariffs imposed on China will apply to all of the Chinese ships coming into U.S. ports. Interpret that however you'd like. There's not a lot of color around that, but it maybe shows a little bit of flexibility in the conversations they're having with China.
It's funny, as soon as you said the news 20 minutes ago, I switched my order from limit to market. I'm like, is something about to happen? I'm going to execute. Back to limit.
Like you've got an hour before the market closes, so a lot can happen in an hour.
Yeah, I leave. It's funny. I always leave at the office at 3:30 to go be at home when Claire gets off the bus, so I don't get that last 30 minutes of the market. I don't know if that's a good or a bad thing.
Last hour of the trading day is usually the most volatile.
Yep.
But buy it now, put a 50% stop loss on it, and
How much percent?
well,
No.
you only want to get stopped out if something really bad happens. Otherwise, the idea of your strategy, it sounds like, is to hang in there until the morning to see if there's a reprieve.
Well, see, that's why you try to buy it at 3:59, so you have no choice, right?
Right.
Okay. Richard, thank you so much. This was one of our longer podcasts, and it didn't really even have much of a direct topic. But this is what's going on in the world, and you have to be aware of this stuff to be able to talk about the other stuff. Join us next week, where I think we're going to talk a little bit about trusts and how to put rental real estate in trusts. Richard, I just put our topic out there today so that we have a whole week to plan for. And we will see you guys next week. Thank you.
All right. Thank you.